Howdy there, folks. Welcome into the rare midnight edition of the Reaction Channel. 2 videos for me to react to super late night here. I was just surfing around, checking out a bunch of stuff, and I was like, oh, these are so good to react to and kind of share my perspective and opinions on here today, okay? First one up here, cash is still attractive. So, going to hear what this gentleman has to say about cash. I want to kind of give my perspective on keeping some cash around. Cash levels, I think, are appropriate in this time period we're in right now and those sorts of things, okay? Then I want to go ahead and react to this video. Affluent consumers are driving a Goldilocks period in spending. So I want to hear what this gentleman has to say. In my opinions, he might be a little backwards looking here, okay? And I'll share some perspective and opinion on that, okay? Appreciate everybody joining me as always, folks. Even if you're joining me late night, early morning, let me know in the comments section when you're getting to see this video. But I appreciate y'all being here. Thanks for being subscribed. New all-time high subscribers, 33,500 plus subscribers on the channel now. So appreciate y'all being here. And by the way, if you ever want to say hello to me, other than through the YouTube comments, you want to send me a DM or something, send me it on IG. I'll have my IG as the pinned comment today. Not sure how many of you guys actually follow me on IG, but if you ever want to and say hi, I post a lot of Instagram stories on there and whatnot. Feel free to do that.
As the market's not out of the woods yet, he expects another possible decline ahead. Let's bring in Jonathan Thomas. He's president and CEO of American Century Investments. Well, it's not Lake Tahoe, but this will do. New York Stock Exchange. It's good to have you here.
Yeah, thanks for being.
So we're not out of the woods yet. Explain.
Well, yeah, our advice to our clients has really been to be patient, be prepared, but also be particular. Everybody feels like we've had this big run up in the market and therefore everything's okay. But we're really, as you just said, not out of the woods. You've got a steeply inverted yield curve, the most negative it's been since 1980. I think everybody knows there's a commercial real estate bubble heading our way as well. And then everybody looks at the market and say, well, it's up 17% on the S&P. But if you look back in 87, it was up 100% before the correction. It was up 60% before 2000, and it was up 30% before 08. So it doesn't necessarily lead to, continued success.
I mean, you bring up things like 87 and big market gains leading into that, especially into the fall.
Right.
Here we go, seasonally, what is not a good period for stocks. Are you looking for a big pullback? I mean, to what magnitude are you talking about stocks really correcting?
So I don't think anybody's really, if you look at the economists and Wall Street prognosticators.
Before he gets into his point, okay, I can tell you what could crash the market, okay? What could crash the market is you would need something, if you're talking about just 2023, okay? So we don't have many months left in this year, let's say 4+ months left, right? In order to crash this market, you would need a situation where something no one sees coming happens, okay? I don't know what that thing would be, but that's what you would need to have happen in order to crash the market this year. If you're talking about 2024, that's different. 2024, you could get the market to go down massively if the economy got hit bad. And let's say, major job losses started coming in. Then all of a sudden, everybody started worrying about corporate earnings and how deep's the recession going to be and all those sorts of things. You can get there in 24 by a situation like that. That doesn't seem super realistic for this year, especially we're running out of time here and with unemployment still being so low. Not super realistic for this year. And especially when you go into seasonal holiday season, there's actually a lot of hiring that goes on. So if anything, the economy should stay pretty good actually for the remainder of this year. The big question is next year. And that's where things could maybe differ a little bit. But for this year, it would have to be something freakish, no one expected to see, and then that happens.
It's kind of split 50-50, and even the people we're calling for the harshest corrections have walked that back to either no recession or a soft landing or a mild recession. And I think that aligns with where we are, too. We're talking about a slight pullback, nothing catastrophic like 87, 2000, or 08. No.
Yeah. In terms of the competition between fixed income and equities, where do you skew on that, just given the rally that we've had, and now we see rates ticking up again? How do you assess that?
So, American Century, we're long-term investors. We're not traders per se. So the advice we give people right now, cash is really attractive. I've always wondered, really since 2010, what are we going to do when cash is yielding 5% or more? Will people even go back into the markets given the volatility they just experienced? And what we see a lot of people doing is there's a lot of people moving into cash and cash-like instruments, gathering that 5%, and then systematically moving in and then being prepared to act if the market does correct. Because the reality of it is, even though the S&P is up 17%, as you know, Scott, it's super narrow. There's 7 or 8 stocks that are driving all of that. So you got to be pretty particular when you do go back in.
I feel like the point you're making, though, is there's still formidable competition for stocks. Whether it's cash,
Absolutely.
where you're getting 5% or whatever you're getting, and then through fixed income, where the risk reward may be better than you see it in equities.
Absolutely, totally.
Yeah. Can you comment too on I don't think enough people know about the commitment that your firm makes to health and well-being, the amount of your profits that sort of go back to society. Can you talk about that?
That's good, okay? I think they should do that, okay? That's awesome. Now, in my opinion, in regards to cash, right? The gentleman's obviously making his point there about cash being good, okay? So what do I think is an appropriate cash level right now? In my opinion, it makes sense to be, if you're light, probably like 15%, but I would put all the way up to like 30%-ish type cash right now. I think there's no problem with being pretty heavy cash right now. Last year, I felt very differently. Last year, I felt like, deploy as much money as possible, pretty much, especially with growth stocks trading where they were trading. The Meta's under $100. Nvidia was down to $100-something, right? Tesla down to $100. Like, you were just getting some insane opportunities, so it made sense just to actually run cash low last year. This year, I feel differently, especially right now, where we're at in the market. And so I think a higher cash level is a good thing to have. I do not think it's smart to be all cash. A lot of investors have kind of been that way for the last 12 months, and they've just missed out on a lot of opportunities out there. And now they need the market to go down in such an insane way just for those stocks to get back there. And even if the market does go down big, those stocks aren't going there. Meta's not going back to 88. Tesla's a crazy one. I won't talk about Tesla. Nvidia's not going back to 110. Nvidia has a higher probability going to 600 than it has to go on 110. Think about that for a moment, right? AMD's not going back to 55. So you run through a lot of these stocks, like, they're not even going to get, even a massive market drop, they're not even going to get remotely close to that. So I think it's dangerous to be all cash, but I think you should have a very healthy level of cash right now. Given the amount of uncertainties, the amount of black swan events that can happen, and given the risk to the economy, and given the Fed lags likely to kick in 2024, right? Potential 2025, but the more likely probability, right? Everything's on a probability scale in the stock market. So the more likely probability is the Fed lags kick in 24, right? And so I think it's a very intelligent time to have some cash around. Most times, you kind of want to run cash a little low because you're usually not able to get very good, returns on your cash, right? Savings accounts yielding 1%, 2%. Right now, you can get savings accounts yielding high 4s right now, right? You can get CD accounts yielding high 4s, close to 5. You can get treasuries yielding 5% plus, 3 months, 6 month, even 12 month, right? So that's my perspective in regards to cash. I think that it's a smart time to have cash and cash equivalents, we'll call it that. Easy money you can get to, whether that's short-term treasuries, whether that's savings accounts, whether that's CD accounts that can earn you interest in this market. I think you want to have definitely a portion over there, but don't go too crazy with it, or you kind of risk the whole I need it to go down so I can buy, right? That's never a comfortable feeling. Next one up here, affluent consumers driving Goldilocks period in spending, right? And before we get into this, I think it's just important that everybody understands this in relation to the economy, okay, in the way inflation works, in relation to the different classes, whether you have the, we can call it the lower class income individuals, the middle class, and then you got the upper class, right? And then you got the rich. So very important you understand how inflation affects those classes differently, okay? If base level stuff, eggs and milk and all this, gasoline prices and energy prices and rents and all that stuff go up, the people it affects the most are the middle class and the lower class, right? Because you're talking about a smaller amount of income pool, and if all those necessities are more money, it's going to eat into, at the end of the day, disposable income, right? Or savings. If you make, $750,000 a year and your eggs are an extra $1 at the store, you don't notice it. It's not even relevant to you. If all your groceries are 10% more, 20% more, let's say even for instance, 30% more, if you make, $1 million a year, it makes no difference to you. You might be annoyed by it, but it doesn't make a difference to you. If your groceries are 10, 20, 30% more expensive and you make 40 grand a year, it's a huge deal. If you have to pay 50% more to gas up your car if you drive an internal combustion engine, right? That's a huge deal that you make 40, 50 grand a year, right? And so you got to understand that inflation hits people the hardest that are in the worst financial situations. Now, eventually over time, especially as Fed lags kick in, then you can talk about that hitting and toppling over even the higher income folks, right? The higher income folks are, what really affects their spending is income. Their income going from, they make, instead of $1 million, they make $400,000. Well, if you're used to making $1 million and then you drop to 400,000, you feel that. You feel that heavy, right? Also, the real estate market. If you're wealthier, you're more than likely, if you're more an affluent consumer, you're more likely own at least one real estate property, if not several real estate properties. So if real estate properties ever get hit, that's going to hit you hard. In the stock market, if you're more affluent, you're going to likely have money in either index funds, ETFs, or you're going to own a bunch of individual stocks. And if the market gets hit bad, that's going to affect you very negatively. And so it's very important we understand that.
Yes, affluent consumers are the key reason why overall spending looks strong. Stuart Sopp is CEO of Current, a fintech company. Stuart, great to have you with us. You're seeing firsthand what consumers are doing.
That's right.
What are they doing?
Yeah, so at Current, we deal with the consumer, the average everyday American. And they're spending on staple goods like you've just mentioned in Walmart, Amazon, Target, Home Depot, places like that. That spending is rock solid. It really hasn't moved that much. And so what they are doing is getting less for their money. And so for staple goods, that's obviously something that's new for Americans. That's just happened. And you're seeing that roll into retail sales coming lower, retail confidence. So the confidence numbers are coming down on the indices. And so from a consumer point of view, they're saying, okay, I'm not getting as much money as I'm not getting as many goods for my money. And then I'm having to spend more money through credit card debt. We hit $1 trillion on that for the same goods. And so for the average consumer, they are not exactly struggling, but they're also struggling to make that money go as far as they traditionally would. So
this causes a lot of confusion, right? I went to North Italia this weekend, places, a zoo. I mean, just completely packed, right? My dad said he went to Cheesecake Factory, I think it was on Sunday night, and he's like, man, how do people have all this money? The place is packed. People are waiting outside in 100+ degree heat. He's like, I don't get it. Like, how do people have all this money, right? You got to remember, and Cheesecake Factory tells us on the conference calls very specifically that many of their customers make over $100,000 a year, right? Actually, much of those customers make over $100,000 a year. So those folks that might be packing the restaurants that are making over $100K a year, inflation affects them a bit, but it doesn't affect them as much, right? So you're going to see the weakness further down kind of the value chain, right? Now, you look at a stock like Walmart. Walmart hit an all-time high recently, right? Well, a lot of Walmart's customer base is getting hit very hard right now, so that could actually negatively affect Walmart, right? Now, on the flip side, people will say, well, if a recession comes, then Walmart's going to benefit from that because people trade down to a Walmart because Walmart's known as the lowest price. So that's where you get into this confusing time where you go to restaurants and you're like, my gosh, like the economy must be the best thing ever. Like, holy smokes, how are all these places so busy? And then you dig a little deeper and you find out the details around that. And then you see a Walmart an all-time high, and it's like, I thought people were struggling. Why is Walmart stock at an all-time high? But then you think about, well, what if a recession comes, right? So this is why it's one of the most confusing times, and I think it's one of the most fun times to be an active participant in the financial markets right now.
You guys obviously have this debit card, and now you just introduced a credit product here. So it's interesting when you think about like the average consumer and you think about the places in which they're spending. Are you starting to see some data that shows, you just mentioned $1 trillion in consumer credit. Are you starting to see any sorts of shift that would lead you to believe that we're going to start getting to territory that feels uncomfortable for a consumer, that maybe many in your demographic are going to start to repay student loans, that sort of thing? And so I'm just curious, do you track that?
We do track that. We're not seeing we're seeing mixed signs is probably the TLDR for us. From an affluent standpoint, which you guys have just mentioned. 22% of credit card debt has been pulled down just now. So you've still got 78%. If you want to take a bullish view for the consumer, 78%. So for more affluent people with big credit lines, the average household has $8,000 on their credit card from $6,900 in 2019, 2020. So there's still some way to go for the more affluent households. 90% of all mortgage rates are locked in below 6%. And so for many people, they're not.
Yeah, let me push back against that for a moment, okay? Because I don't think that's the right way of looking at it, saying, somebody's, only using this portion of their credit card and they still got this much left, right? I have credit cards I have, I don't even know, $70,000 limits on, $30,000, $35,000, whatever, right? I use a very small fraction of that. Now, how does an affluent consumer use a credit card? Think about this logically for a moment, right? We use it for points. We're not using it for any other reason. Like, we could easily pay with a debit card or credit card, but why would you do that when you can get three times cash back or 4 times or whatever the number is? It doesn't make sense. So that's why you use credit cards. It's very different than maybe other folks. Some other folks that aren't in a good financial position might be using a credit card to buy something they really can't afford at that given moment, or to make ends meet, right? It's a very different view. So yeah, I don't like that whole, affluent consumer credit card. I think that's like a silly way of looking at it, to be quite frank, in my personal opinion at least, right?
Move house, they're not going to move jobs. And so if you want to take a bullish look from a more affluent point of view, there is some dry powder there to go. Now, for the average consumer, the average American who's trying to make those staples go as far as they can, I don't think there's that much breathing room for them. And so credit building is such an important part and in your credit score is such an important part of your APY of how much money you spend on your debt. We've never needed to look at that over the last 10 years, right? So you've got debt and it's just been like whatever it is. Now, because you're sensitive to that interest rate, you're now going to look at the inputs to that, which is like your credit score. And so we've got this product called Build, which helps people, everyday Americans, build their credit with their bank account.
What's your take on how consumers view that dry powder, that remaining credit line that they can still use if the interest rate is 26% or whatever horrifying rate it is these days?
Yeah, I think this is what's coming into the psyche of like whether you pull down or not. And so definitely when it comes to mortgages and auto loans and things like that, you're probably not going to look at them too often. But when it comes to revolving credit, I do think if it comes to staples, which is starting to happen now, you are going to pull down on that line. You're going to feed your children, you'll feed your family over 22, 24% on that APY. And again, that's why I think that credit building and maintaining a good credit score in this time for people on 25 to 55K, somewhere around there, 75K household income, it's a really, really important thing to do for this year.
In a former life, Stuart was a trader at Morgan Stanley. So it's great to have him on here from his view. What do you make of the bond market moves and some of the currency moves that we're seeing? Obviously, it's no impact on the stock market, but is it just sort of inevitability with that?
Yeah, good question. So I think when it comes to the retail stocks that you're seeing right now, I think you will see earnings beats and revenue misses. But overarchingly, what we're going to see is liquidity draining. So the bond market's going to drain the liquidity. It looks like it's happening already. And so we'll see this sort of volatile to sideways move. We're all going to make bets. I heard you make a pairs bet just now. So we're all going to be making these bets, but and I'm sure they're smart. But I think over the next 2 or 3 months, the overarching theme will be liquidity drain. We have too much issuance. The Japanese market is in turmoil, although the BIJ are doing a good job, I think. And I think that'll be the dominating factor over the summer until everyone's back from Labor Day.
Interesting thoughts there. They snuck that one out of the former Morgan Stanley trader there. So it's a very confusing time in the economic environment we're in right now. I think it's going to continue to be. I don't see this mess getting cleaned up anytime soon, and I think you just got to be very agile over this next 1 to 2 years. And I think you've got to I think this is a market you've really got to watch cash levels. I think there's opportunities you've got to take advantage of in the market from the long side. And I also think you got to have some proper hedges on just in case some things get pretty ugly. Okay. So appreciate everybody joining me as always. Thanks so much for being here, folks. Thanks for being subscribed. New all-time high subscribers. The Midnight Edition. Much love and have a great day.